Good morning to North America and good evening to Japan. This is the webinar series by School of International Public Affairs, Columbia University on central banking. And today's topic is central bank digital currency. And this is very topical issue because the BIS issued a major report study by 8 central banks issued last month. And also the Brookings institutions published a very thick report. And we are very fortunate to have the 2 central bankers who joined the joint study and main author of the Brookings report. So let me briefly introduce the panelists, 3 panelists, and in the order of the initial remarks. So the first panelist is Eswar Prasad. He's Tolani Senior Professor of Trade Policy at Cornell University, and he's also a Senior Fellow at the Brookings Institution. And he spent many years previously in IMF, and he was once the IMF China division. And I had a privilege to work with him in the mid 1990s. And Eswar has many books, but the most recent one is called Gaining Currency, The Rise of the Renminbi. And I'm sure that he's writing a new one right now. The second panelist will be Sir John Cunliffe, and he's a Deputy Governor for Financial Stability at the Bank of England. And he's a key person in BIS Committee on Payments and Market Infrastructures. And before joining the Bank of England, he was at the HM Treasury, and he rose up the ranks. And from 2002 to 2007, John was second permanent secretary at Her Majesty Treasury and managing director of the Macroeconomic and International Finance Directorate. So around 2000, 2001, I think I was at the Ministry of Finance government of Japan for 2 years, and I think that is where I met him first time. The third panelist from Japan, Shinichi Uchida. Thank you very much for staying so late, Uchida-san. And he joined Bank of Japan in 1986 after graduating from University of Tokyo Law Department, and he rose up the ranks in the mainstream of the Bank of Japan, and he is now the executive director in charge of planning and payments and financial markets. So this is the order of the 3 panelists. And I will start with Eswar to explain to us the current state of the thinking about central bank digital currency. Eswar, floor is yours.
Thank you, Taka, and thank you for that kind introduction. I should say that it was my privilege to work with you at the IMF. You were already a legend back then, and to many of us economists, you're still and even greater legend in terms of how you combine your rigorous academic research and your policy work. So it's a real pleasure to be on the panel with you. I should also mention that the Brookings report that you noted, I'm one of the authors there. In fact, I was the only economist on the team, which is comprised of a number of my Cornell colleagues who are cryptographers, computer scientists, and know far more about technical details than I ever will. So I learned a lot from them indeed. So as we think about central bank digital currencies, it's worth clearing up some definitions right at the beginning. A lot of central bank money, especially bank reserves and money that is used for interbank payment and settlement, is already digital. So what we're really talking about here today and what could be the new frontier of money is really retail central bank digital currency. So rather than having dollar notes or yen notes or pound sterling notes in our wallets, perhaps we will have access to some form of digital central bank money. Now, it could take two forms. One could be something as simple as money that is loaded onto an app. So it could be as simple as e-money that you go to a financial institution or other financial services provider, download onto your app, and then use for payments. But what is a far more exciting prospect is the notion of having literally an account with the central bank. Typically, one would think of it as being a non-interest bearing account, but one that could be used for payment for retail transactions, payments among businesses, and so forth. And that version of a retail CBDC, I think, has a lot of promise. So one question right off the bat is, why are central banks thinking of issuing CBDC? And the motives seem to be different across countries depending on their stage of development and their needs. Some countries such as Ecuador, which tried issuing a retail CBDC, Uruguay, which ran an experiment of this sort, many of these countries seem to view financial inclusion as a very important objective that can be pushed forward using a CBDC. Now, certainly you don't need the central bank playing a big role here, but if private payment providers are not giving easy access to retail payment systems and other financial services to a large part of the population, one could think about a retail CBDC as providing that kind of functionality. Another aspect, which has been emphasized by the Riksbank in particular, is to think about the retail CBDC as providing a backup payment systems. Now, in Sweden, the use of cash has almost disappeared entirely, and the payment systems are being handled by private payments providers, and they're doing a very good job of it. But the question the Riksbank asks, which I think is an important one for all central banks to consider, is if the entire payments infrastructure is in the hands of private providers, and if there is a crisis of confidence or some other issue that raises counterparty risk, the risk that one of these payment providers might face financial difficulties, you could well see the entire payment system folding and leading to a serious economic problem. And basically, if the payment system freezes, an economy freezes. So one could think about a retail CBDC as basically providing a backstop. So these are the main motivations that are considered, but there are other reasons why you might consider retail CBDC as well. One can think about it as pulling many economies, activities out of the shadow economy, broadening the tax net. One can think about other sorts of objectives, social objectives that can be easily managed, such as cash transfers from the government. In principle, it could make these helicopter drops of money, this notion of the central bank being able to go in and give each person in the economy a certain dose of money. It's usually done through fiscal policy, but one can think about this being done more directly if everybody had a central bank account. Some economies have undertaken negative interest rate experiments. In principle, if everybody had their money in a central bank account, implementing a negative interest rate would certainly be a lot easier in an economy without cash. So there are a variety of advantages, but anything, including a CBDC, is not without its costs. I spoke about how you could have the CBDC being a retail payment systems that is a backup, but it could end up squelching innovation by private payments providers. And that could be a serious problem in terms of blocking innovation. Another risk is that if you did have access to CBDC accounts, perhaps in a time of financial panic or even some concerns about the financial system, you could have a wholesale flight of deposits out of the banking system into the central bank digital account. So there are some important risks to be considered. And I think these will have to be thought about not just in terms of their economic considerations, but also their political and legal considerations. So for instance, do we really want to live in a world where I might be able to buy Professor Ito a cup of coffee with either a payment services provider or the government knowing about it? If we did not have access to cash, certainly illicit activities would no longer be easy to conduct using central bank money, but even perfectly legitimate activities, one might not have the cloak of anonymity anymore. And another question is whether the central bank should really be doing things which the private sector can do perfectly well on its own, including providing payments, including providing a variety of financial services. So certainly these days, many central banks, including the BOJ and the Bank of England, have had to become the main policy drivers in terms of protecting their economies from financial collapse, from economic collapse. And this is a serious concern for central banks, whether they in fact want to take on what might ultimately end up being a broader set of government mandates that could in principle be intermediated through the CBDC. The academic question about whether a CBDC makes monetary policy more efficient, more effective in terms of transmission, I think the jury is still out. Many academics, including myself, are working on it, and the answer to that is not obvious. And what many central banks seem to be contemplating right now, this is what the People's Bank of China is considering, this is what the Bank of England, per its recent report, seems to be considering, is a sort of dual layer system where many of the risks related to CBDC are managed by the central bank issuing the CBDC, but then the retail wallets being managed by commercial banks. So commercial banks would have on their books these non-interest bearing deposit accounts in the form of CBDC, but also their traditional deposit accounts. And one could then think about the CBDC as being effectively tokens that can be intermediated across different payment systems. So perhaps there is a nice way in the middle where the CBDC starts helping private sector providers innovate in terms of payment provision, and where the CBDC facilitates that process rather than squelching it. So I think there are very interesting developments to come in the area of CBDC, but also a great number of questions that have to be answered that are related not just to technical, economic, or monetary policy issues, but really much broader societal issues that I think will have to be dealt with.
Thank you, Eswar, and thank you very much for laying out important issues, merits and shortcomings, possible shortcomings of issuing retail CBDC. And next, I'd like to ask John Cunliffe to come in, and I expect he will cover the recent study by 8 central banks. But very timely topics. So thank you, John, and the floor is yours.
Okay, thank you very much. And just to confirm, you can hear me clearly there. It's coming through clearly?
Yes,
yes, we can hear you clearly.
All right, no, I had some problems connecting, and I had to prove along the way that I wasn't a robot. So I seem to have managed to do that, but just wanted to check. Look, maybe I could just pick up some of the points that were just made. I want to make 3 general points, and then briefly to describe 2 CBDC multilateral initiatives, the work that was just referred to by a group of central banks, and then the work that's just starting under the G20 cross-border payment initiatives led by CPMI and the Bank for International Settlements. So first, the general points. Just to say, this is not a new issue. I mean, we all know money is a social convention, and the forms that it takes in society changes over time, and it changes with technology. And we have different types of money circulating in our economies at the moment, public and private. And we get carried away a little by crypto and CBDC, but money has changed remarkably in our society over the last 50 years with existing technology. So I'm quite old, but when I grew up in the UK, 70% of people didn't have a bank account, and about 1/3 of the money held for transactions, and most of the transactions were in physical cash. And now we've got nearly the whole population, I think 98% with bank accounts, and only 5% of money is held by the public in the form of physical cash, state money, and 95% is commercial bank, private money that coexists and circulates within it. So that's a quiet revolution that's happened to suit the way we live, the way that's changed. And it's happened, I should make this point, it's happened and banks' business models have changed alongside it to allow it to happen without great furore or the idea of cataclysmic change. So I think we should see what's happening. It may be happening more quickly and bringing in new actors, but I think we should see what's happening as an evolution of money, not some sort of fundamental revolution. And that brings me to the second point, which is central banks tend to express their objectives as monetary and financial stability, but ensuring the provision of a safe, a reliable, a stable and a convenient currency, a kind of means of exchange, is really at the core of what central banks do. And history tells us what happens when money used for payments is not safe, reliable and stable. And that's true whether we're talking about a public money, like a central bank digital currency or central bank cash, physical cash, or whether we're talking about a private money, however it's provided. So if new players do emerge, then the new private monies that emerge have to meet those standards in the way the current private monies do. Now, there are other considerations which Iwo just referred to. This is not just for central banks. There are issues around competition, issues around privacy, issues about prevention of financial crime, issues around inclusion. That involves political authorities, and actually the involvement of political authorities in debates about money is not new. Money is so central to our society that the political authorities need to be involved. But whatever comes out of that political engagement, I think has to meet the tests that I said at the beginning for safe, reliable, stable and convenient money. And I've said convenient, and that brings me to the third point, which is that the forms of money adapt to the way we live rather than the other way around. And if the way we live changes, and now it's changing very rapidly, it was changing before the COVID crisis, and those changes have been accelerated by the crisis, then the forms of money that enable us to live in that way will appear. And we can't just ban them and say we don't want that form of money here. We either have to make sure that they're safe in private form, or we have to provide a safer public alternative. And that brings me to the central bank digital currency and the two initiatives I mentioned. A year ago, a group of 7 central banks and the Central Bank of Central Banks, the BIS, came together to work on CBDC, and our report was published last month. You can find it on the BIS website or the Bank of England website. And we came together as similar economies with similar financial systems to explore these issues. We didn't come together to develop a blueprint. None of us has taken a decision yet to implement a CBDC, and we might not take that decision in the future. And our work was about domestic CBDCs. Even though this was a number of central banks coming together, the focus was not on cross-border CBDC. It was really about the issues around the introduction of a domestic CBDC. And we focused on a retail general purpose CBDC. I'd sum that up as saying effectively digital cash, something that households and firms could hold the way they hold digital cash at the moment. The conclusions of the report, I think, are kind of 3 important points. First, we came to agreement on 3 core principles. The first one is that though this was intended as a payment CBDC, we must make sure we did no harm, a do no harm principle, to monetary or financial stability. Second, that the form of CBDC we came up with had to coexist with other forms of money, be that physical cash produced by central bank, or private money, commercial bank money, or money provided by new providers. And third, we had to promote efficiency and innovation, and that meant some sort of public-private interface, either in how a CBDC was provided, or as well as how other monies could interact with that CBDC. And the second part of the report detailed the core features that we agreed would be needed for a CBDC of that type. There are 14 of them, and I'm not going to go through them all, but some of them are about the instrument itself. It's got to be convertible at par. It's got to be convenient. You must be able to use it in the same way you could use a debit card or tap your phone or use physical cash. It's got to be broadly accepted in the economy. Some of the core features are about the system, resilience. It's got to have instant settlement finality. It's got to be operational 24/7. It's got to be accessible to other systems for the reasons I gave earlier. And some were about the institutional framework, the legal framework, who is actually responsible for the central infrastructure. And the last thing is we set out a number of key trade-offs that go along with those core features, and they involve things that have already been mentioned, such as the trade-off between privacy and prevention of crime, which will be an issue not for the central bank, but for the political authorities. Now, it's for each central bank in that group to decide, as I've said, whether it wants to introduce a CBDC, and none of us have decided that. But we did conclude that a CBDC designed on those lines, with that use case, with that purpose, a general purpose retail CBDC, could be an important instrument for central banks to deliver their public policy objectives. And the next stage is we're going to explore those trade-offs more, and I think we'll try and do some joint experimentation to take the work to the next stage. Now, I said interoperability wasn't the main purpose of that report. We did discuss it, but maybe that brings me to the second initiative, which is the G20 now has agreed a very large work program to improve cross-border payments, which at the moment are slow, unreliable, very expensive, and not available everywhere. And that's as a kind of global public good. And it's actually the shortcomings of current cross-border payment system that's driving some of the new developments, the stablecoin developments, the Libra developments that one is seeing. Now, most of the work is about improving the current cross-border arrangements, trying to remove the frictions and the costs of that. But some of the work is also looking at new technologies like CBDC to see how CBDC could actually contribute to improving cross-border payments. I can't give you the conclusions of the work because it's just starting. I hope the output will explore different ways CBDC could actually help with cross-border payments. There's a range of options, from interlinking systems to making systems interoperable to actually integrating systems. And I hope the work will actually set out how that works, again, what the design choices and the trade-offs are there. Most of us are looking at these things at the same time, CBDC. So we have an opportunity to ensure, at the very least, that we don't make choices which rule out sort of use of CBDC cross-border at a later stage. And actually, I hope one could go further and we could build in the optionality to do that if people wanted to. So I will stop there, but happy to take any questions on any of that. Thank you.
Thank you very much. And the third panelist is Shinichi Uchida, Bank of Japan. The floor is yours.
Thank you, Professor Ito. It's a great pleasure and honor to be here. In early October, the BOJ published its strategy on CBDC along with the Central Bank Group report, which John just explained. While we are yet to decide whether to issue a CBDC or not, we think it necessary to prepare to respond to possible changes in circumstances. As we all know, the development of digitalization is so rapid. Just 15 years ago, we didn't have an iPhone. So nobody knows what will happen in the next 15 years. If we are to issue a CBDC, it will meet the foundational principles and core features provided by the Central Bank Group report, taking our particular situations into consideration. So first, a CBDC will coexist with cash. In Japan, banknote issuance amounts to over 110 trillion yen, or 20% of our nominal GDP, which stands out in the world. It was 8% in the United States, 11% in Euro area, and 3% in UK. This is largely due to the low interest rate environment we have experienced for a couple of decades. People have little incentive to walk to a bank and deposit money just for a small amount of interest, so-called sure leather cost story. That said, it is also true that Japanese people like cash. Cash is widely used in our daily life. And in a sense, I think we should be proud of it. There's almost no counterfeit. It is safe to bring cash even at midnight. Banknotes are maintained clean, and most people don't feel uneasiness in touching cash even in pandemic. We can withdraw cash at convenience stores, which you can find everywhere in cities. All in all, cash is safe and convenient. Therefore, we think it's unlikely that public demand for cash decreases in the near future. The BOJ commits itself to continue providing banknotes as long as there is demand. Actually, this is in line with the Central Bank Group report. However, the situation may change. For example, declining population may place upward pressure on cash distribution costs. While Japan is a country with relatively dense population, the population declines sharply in rural areas. Therefore, it may be the case that access to cash becomes difficult in some regions. And secondly, on technologies and innovations, we should design the CBDC so as to promote innovations. BOJ made it clear that if we are to issue a CBDC, we will maintain two-tiered system over central bank and private sector and issue it in an indirect model through intermediaries. The role of central bank will be to issue a digital payment instrument with finality and manage the overall framework. And the private sector will continue to provide interface with end users, accommodate ever-changing customer needs, and promote innovation through their knowledge and technologies. We think the cooperation with the private sector is a key to success. And more broadly, we think we should always try to make the whole payment system safer and more efficient at the given technologies. And importantly, there is an inevitable trade-off between the efficiency and soundness. If an innovation, a CBDC or any other form, gives us a better position in this trade-off, it is worth considering it. And thirdly, on financial stability and monetary policy. As stated at the Central Bank Group report and our own report, careful consideration is required in designing CBDC so as not to harm financial and monetary stabilities. For example, limits on the amount of issuance or holding will be an option to avoid possible digital bank runs and disintermediation. And CBDC may also have some implications on the effectiveness of monetary policy, as mentioned by Professor Prasad. For example, it is often argued that central bank can impose deeper negative interest rates if there is CBDC. But I don't think people will support CBDC in order to allow their central bank to impose deeper negative interest rates on their money. While it may be true that central bank can create more tools by using programmable money, such a consideration cannot be a motivation to introduce CBDC. let me repeat that main motivation of CBDC will be and should be to improve the efficiency and soundness of the whole payment system. And fourth, very briefly on privacy. Anonymity is one of the features of cash. It is important to strike a balance of privacy protection and the requirement of AML-CFT in a digitalized world. But more importantly, we should also consider who obtain and manage what data under what conditions. Data should be protected, but also be used as appropriate. This is one of the most important motivations for platformers and will be so for financial industries. Financial institutions create values by producing and assessing information. Therefore, we should consider how and to what extent we can allow intermediaries to use data. The appropriate level of privacy and use of data is a fundamental question to be discussed widely in public. In fact, this is not a new issue for CBDC. And finally, let me emphasize the importance of cross-border interoperability. I quite agree with John on this point. The discussion and the decision of whether to issue and in what form is up to each jurisdiction, but CBDC should improve efficiency and soundness of the payment system, not only domestically, but also for cross-border transactions. And Central Bank Group report clearly stated that the potential for cross-border interoperability should be considered by central banks from the outset of research on CBDC. So the cooperation is a key to success internationally as well. Let me stop here. Thank you.
Thank you very much. And I think I'd like to remind audiences that please submit your questions, if you have one, to the Q&A box, and I will collect them and rearrange and ask the questions in the floor discussion time. But before doing that, we have the discussant, and my colleague, Professor Trish Mosa, will ask several questions. And Trish and I are co-organizers of this central banking webinar series. And Professor Mosa has spent many years in Federal Reserve New York and US Treasury Department. And at the New York Fed, she was in charge of the dollar swap arrangement during the global financial crisis in 2008, 2009. So she could represent Federal Reserve System and could explain why the Federal Reserve was a latecomer to this joint central bank study. And floor is yours.
Yeah, thank you. Good morning, everyone. I should say good afternoon and good evening as well, given that we have people from all over the world on. I'm not going to begin to represent the Federal Reserve anymore, for the record. But I do have a couple of questions for the panelists. One is a macro question about trade-offs, and the second one is a little bit more micro or operational. So let me start with the macro question. One of the big concerns is how to introduce a central bank digital currency in a way that does not disintermediate private digital currencies, meaning deposits, and therefore disintermediate the banking sector. And this is mentioned in almost every paper and note written about central bank currencies, digital currencies. It seems to me that there are two or three possibilities that are generally raised as how to do this. First is it's a currency. We keep a digital currency at zero interest rate. Means as long as interest rates are positive, it's going to be less attractive to deposits, private sector deposits, except perhaps to the unbanked. But if financial inclusion is part of the goal, maybe that's not such a bad thing. The second option is have it be interest bearing, but limit the amount of central bank digital currency that any particular private sector agent can hold, a la the suggestion that Shinichi just had. And last but not least is to perhaps to somehow tier the interest rates. So the last of those seems kind of complicated. So I'll set it to the side a little bit over here. And here are the questions. Under the first case, what happens to bank disintermediation when policy rates are actually intentionally set below zero, as they are in a number of large advanced economies? The second case of limiting the amount that anybody can hold actually seems to violate one of the core basic features of central bank liabilities, which is convertibility. In other words, between private and public money, between currency and deposits. If the size for individuals is limited, then in some states of the world, you're not going to be able to convert a central bank digital currency to private sector funds. That will sort of be the whole point. You're limiting it. So it's not, in that sense, it's not like paper currency. Not only that, the state of the world where everybody's likely to want to hold it is probably a case during financial distress. And so you've probably got some financial stability concerns going on there as well. So my question, my big picture macro question is, there's clearly trade-offs with all of them. What's better? So I guess I'm asking for an opinion from the three panelists to understand better what their priors are about the importance of those trade-offs. And I'm happy to have anybody go first.
Okay, so you want to have the answers, right? So let's try John.
Yeah.
Just unmuting. No, thanks, Patricia. Look, they're very relevant questions, and they go to that do no harm. But maybe a couple of points. First of all, there are price and quantity tools, which is what you mentioned. I'm not sure I take the same view on limits necessarily, because actually there are limits to the amount of cash people can hold. I suspect if you go into your bank tomorrow and ask to withdraw a very large amount of cash, you'll get asked some very interesting questions, actually.
Yes.
It's, you know, people say we can't limit cash, but actually people are used to frictional and other limits on cash. So first of all, I don't think that for me is a sort of obvious that it can't be used. And on price, people already differentiate where they put their money by how much liquidity they want. Do they put it in term accounts? Do they put it in sight deposits? So I don't know the trade-offs, but I mean, to me, these are issues about, I'll come on to how you manage these problems. The second point I'd make is we don't know the behavioral response of consumers. We just don't know how much of this they'll want to hold. And some of those questions you raise, we have no empirical evidence because we've not had this form of money before. So I think some of these things will have to evolve as we gain, if we implement these things, as we gain experience of them. I don't think you can know in advance just how people will react in business as usual or in stress because somebody raised the bank run point on the chat. And the last point I'd make is really, well, first of all, our job is not to protect bank business models. Our job is to ensure that if bank business models change, you know, we manage the financial and macroeconomic consequences of that. It's not the job of central banks to keep, and I tried to set out in my initial remarks that those business models have changed hugely. I mean, they just weren't in the buying a cup of coffee with a sight deposit transaction business, even 10 or 15 years ago, and they will change again. You know, 100 years ago, banks in the UK just didn't lend on real estate. It was thought anathema. So we shouldn't think of this as kind of some fixed thing. Banks will have to adjust. It's our job to make sure that the adjustments are actually manageable within that. And lastly, was my other point, if a new private money comes along using different rails, a stablecoin, a Libra, you'll have exactly those issues. Those issues aren't for a CBDC. So you may want to ask the question, can I ban it? And that goes to my point. I don't think you can hold back the way people will change the use of money when technology changes to suit them. And if I can't ban it, is there a better alternative? Or can I manage those issues better from the central bank end? So I didn't answer your question, but I don't know the trade-offs yet. But it strikes me these are issues to be managed, not these are issues which say, you know, you can't go there.
So perhaps I can add a couple of points to that set of observations. I think it's a really important question, and it links up to what Mr. Cunliffe said earlier, that in modern economy, central banks create money, but they're not the main providers of money. It's really the commercial banks, despite all the vilification we may direct at them, which are the main creators of money. And there is an open question whether we want the central bank to take on that role of providing credit in the economy. And I suspect it's not just the central bankers, but most of us academics would answer that question in the negative. So then the question becomes, how does one avoid disintermediation in periods of crisis if you make such disintermediation easier? And you pointed out a couple of routes, Patricia, and one of those, in fact, has been adopted by the Central Bank of the Bahamas, which has already launched its sand dollar, and they have a limit on the amount of retail CBDC that an individual can hold. The limit is somewhat higher for businesses. I've been doing some analytical work looking at this, and it turns out that in an economy where you impose a limit, you get slightly lower welfare than in an economy where you allow agents to hold higher amounts of CBDC when there is a negative shock, but you impose a higher penalty. So maybe there are circumstances, very bad states of the world where people want to move more money into CBDC accounts, and they may be willing to pay for that safety, in which case it becomes certainly viable. But in my mind, again, one should not, as Mr. Cunliffe correctly said, one should view this as really an issue of doing no harm and trying to make the financial system work better, which I think can be done in a way that the CBDC provides additional functionality, increases efficiency of the payment system, but without necessarily disintermediating the banking system. But this is, again, an open issue about what happens in really bad states of the world, whether you could end up creating the very financial instability that a CBDC is trying to avoid.
Yeah.
Yes, please.
Yeah, I think this solution will be a kind of mixture of several design features. I mean, first, we can mitigate the problem you have raised by allowing a two-tiered system in payment system. We can allow intermediaries, which will be banks mainly, to deal with the CBDC in their own business. That's one thing. And another is that the coexistence with cash is one solution when we put a limit on the amount of the holding for each deposit holders. And well, the zero interest rate will not work under the current situation, and maybe so in a foreseeable future, at least in Japan. But then in a normal case, or I don't know what is normal, but then in a normal case, it could be in one options that will avoid the possible disintermediation. So I think that there's no clear answer by just one of the features, but then the mixture or the package of these design features could solve the problems you have raised.
Thank you. That's very interesting. So I have a very quick, I hope quick more operational question, which is about the tiered or hybrid solution where the central bank provides a digital currency, but private firms, including banks, are actually the ones who manage the accounts. Now as a former central banker, that has great appeal. Central banks do what they're good at, and the private sector does what it's good at. It seems very sensible, but it raises a whole host of questions. It seems to me a huge amount of the innovation going on is actually in many of these cases is actually outside the banking system. And so the non-bank inclusion in being part of this system seems a logical place to go, but that raises at the same time a whole bunch of questions about interoperability and real-time payments and so forth. The private sector, largely banks, have done this for a long time, but honestly, they have not always been so keen on doing things like making things instantaneous, particularly in the payments arena. And so I think there's a host of trade-offs. Part of that, as John Cunliffe pointed out, is not the central bank's responsibility. It's going to have to be the rest of the government's responsibility to set the rules of the game. But where is that where this conversation, both nationally and internationally, is headed? Because it seems to me until you start to tackle some of those things, you're going to have a hard time doing this in practice.
May I add on to the Trish question that several audience asked the technology question that as Trish mentioned, innovations are happening outside banking sector, which is blockchain or other means that is not in the banking sector, and some of them are faster, some of them are more secure, and so on. So what technology that central banks are thinking to adopt when you are talking about central bank digital currency, and is it compatible with current banking commercial banks, or is it more in competition or coexistence with the outside banking sector technology?
So I think these are really questions for the central bankers, Uchida-san and Sir Cunliffe, to answer, but I'm going to sharpen the question that both of you, Ito-san and Patricia, raised by bringing it into the context of talking about stable coins, which the BOE had released a report about. So if you think about payment systems, there are many payment systems out there. In the US, you have Venmo, PayPal, we have other payment systems coexisting without being formally banks. But what is interesting is that if you think about something like Libra, that is intended to be a payment system, but what it is building off is really the trust in central bank money. So what seems to be important for something like Libra is the notion that it is not an independent payment system, but one that is backed up by central bank money. So then one can think about central bank money as essentially being managed in a different way as a sort of foundation for a payment system, rather than actually being involved in payments directly. So you don't have even the sort of approach we're talking about right now, where the digital wallets are being maintained by commercial banks and the central bank money is being used for payments. And the central bank money sort of gets stored somewhere, and then something based on that gets sent around as the form of payment. So one very specific question that would come up in this context is, are both of you central bankers happy with the way Libra is has repositioned itself? I know initially there were lots of concerns about how it would be managed, whether the reserve assets would be reliable backing for this new medium of exchange. So are you happy with the conception of Libra where it is right now? And would you be comfortable with it working as a stable coin? Do you think you need to issue your own stable coin as a sort of competitor to that?
May I invite John?
Okay, so I'll go first. By the way, just to pick up something that Patricia said about, we have to resolve some of these questions that go beyond central banks before we get very far. I agree entirely. And I think the political side is a long way behind the central banking side in thinking about those issues. And they need to go up the political agenda quite fast before actually the political side discovers there are developments in the private sector, say, that actually don't fit with public policy. So yeah, that needs to happen, and it hasn't happened yet. But people do wake up to these things, I think, when they need to, and my guess is they will. On the question of the question of technology, we're not there yet. So one of the questions, so the moment we released our discussion paper at the Bank of England, I got calls and emails, mainly emails, from people telling me they had the system we needed. Just if we just sent a if we sent a virtual truck along, they would pick it up and we could put it in. And the fact is, I don't know if this is a distributed ledger system or central ledger. We can get into long arguments about tokens versus claims, and we can get into arguments about central versus distributed ledger, and we can have discussions about, as somebody's put in the question box, should we use crypto technology? Actually, you don't need to use crypto technology for some of this. Existing technology looks as if it can do a lot of this. I think in China, actually, it's not a DLT system. System they're thinking about is based at the moment anyway on existing technology. In a way, it illustrates for me that one should not start this discussion from what can the technology do. One should start this discussion from, if there are going to be developments that allow this to happen, what do we want? A central bank digital currency or a stable coin? What do we want that to deliver? And then this is what the technology has to do. And if the technology people then tell us, well, there's a trade-off, okay, we'll sort out the trade-off. But we should start from that end. And I don't know the answer. And it may be a number of years before people know the answer, even if they decide, quickly to go ahead with the CBDC. And then finally, on this question of Libra and stablecoin, I really think you do need to think of the two things together, because many of the do no harms, many of the things you would want come whether you do it via a private money or a public money. And these would be private monies that operate outside the existing rails, if I can put it that way, operate outside bank ledger systems, and bank ledger systems all funnel into, at the moment, to central bank ledger systems. So this is a different thing. But the Financial Policy Committee of the bank sort of published two expectations for stablecoin. One was a general expectation that the payment system part of it needs to be as secure and give the same end-to-end reliability as the payment systems we use at the moment. And that has to cover the whole chain of the payments activities. And that requirement is true now in conventional payment systems, which are fragmenting into lots of different providers, that you have to have end-to-end resilience. And the second is, if you are providing the settlement asset as well as the payment system through which the asset moves, then that's a private money, and it's got to have the same level of security as other private monies. Now, Libra want to launch, they've said they want to launch a sterling stablecoin. We've had some discussions with them. I don't want to go into where they are, to something. I think their proposal's been evolving anyway, so I couldn't necessarily say where they are. But a private money needs to be convertible into fiat at par on site. That's what we have at the moment. And that's what I would look for with a private stablecoin. And then they have to show how they can back up that promise. And there are different ways you can show that. You can show that as commercial banks do, with a combination of central bank supervision, prudential requirements, liquidity requirements, access to the central bank, lender of last resort, in crisis. I mean, there's lots of different deposit insurance at the wallet level, different ways you can show that. In the UK, we have Scottish banknotes, where Scottish banks issue their own banknotes, but they back them one for one with Bank of England banknotes, actually banknotes, because the legislation requires it. Somebody signs £1 million banknote to give it to the Scottish banks. I don't know necessarily how that convertible into fiat at par on demand assurance is delivered, but it needs to be delivered for new players. And the last point is, you can envisage a world in which people move backwards and forwards from a stable coin to a CBDC. They, for different reasons, they offer different things, but want to make sure with whatever we do that if we provide a central bank digital currency, everybody can use it, different developers can use it, and we don't wind up with kind of walled gardens where we have some monies that just aren't substitutable and transferable into other monies. I think that's important in terms of efficiency of money in society. Stop there.
Shinichi.
Yes, thank you. And I quite agree with John, and not many things to add, but then probably, well, 2 or 3 points. One is that the technology and innovation is not the same. I think, technologies, well, most of technology developed in outside the banking system, but then still banks and financial institutions can make innovations based on that technologies. They can accommodate customer needs in financial services and other things. Of course, DLT and others should be developed in a different world, but that kind of things always happens in their world. And on the technologies, DLT or the traditional or incumbent technology, I think that it depends on the features or design of CBDC. But then if we try to make a kind of hybrid of account-based and token-based structure, in that case, maybe we should try both of these technologies, because we don't have enough transaction capacity under DLT, but if we try to coordinate all the manage all the payment system in total, but then if we have a hybrid system of account-based and token-based system, maybe we can use DLT in a offline-based transactions, which is just a part of the whole payment system. But anyway, we have to think. We will think about these kind of things through the experimental phase from now. And secondly, on Libra, I think that the same rule, same regulation is a principle we agreed internationally. Bank is the Libra is a non-bank institutions as a character, but then they behave like a non-bank. But if their functions or the business is close or similar to the activities of financial institutions, they should follow the same regulations or same rule. So same rule, same activity, same rule principle is a solution. And finally, the criteria of the most important thing is that to design for payment system safer and more efficient. That's a criteria we should think about when we design the payment system, and to what extent we allow non-bank institutions to get into that system. So we can design that way given the technologies at that time. Thank you.
Thank you. So let me add one word that I think Tether claims to be a stable coin backed by 100% by the fiat money. And it reminds me of this great debate of the narrow banks in the as a financial stability topic, and it's a digital narrow bank, if that is what it claims. And traditionally, narrow banks doesn't work because it doesn't make money for the bank. And this time it is overcome because of the technology. I'm not sure, but if you start imposing deposit insurance and so on, then definitely it doesn't make any money. Well, it's not a viable business. But let me shift, if you don't mind. We go several minutes over time, and we have a burning question on big elephant in the room that is China. And PBOC has been actually experimenting already on various forms of central bank digital currency. And we read that they distributed some digital currency to the citizens directly, media claims, and so on. And so what's going on in China? That's first question. Second question is a little bit more sensitive question, that if China succeeds in digital currency and goes cross-border, international digital currency, would that have a potential to upset the US dollar as an international key currency? I don't worry about sand dollar, but I think the renminbi has a chance to become a international digital key currency. But may I invite Eswar to speak about this Chinese experiment and potential for the international key currency?
So the Chinese digital currency, or the digital currency for electronic payments, DCEP as it's called, is certainly in the advanced experimental stages. It's been rolled out in a number of cities, and the main architecture underlying it is this dual layer architecture that I spoke about, where the digital wallets are maintained by the commercial banks and the CBDC is provided by the central bank to the commercial banks, much as is the case with physical cash right now. I think one of the reasons why this PBOC is doing it is really because the dominance of the two major payments providers, WeChat Pay and Alipay, raises a series of questions about not just the stability of the banking system, but the oligopoly power that these two institutions could have. And I think the PBOC is very concerned, not just about financial inclusion, but also about whether financial stability could be put at risk if virtually the entire payments infrastructure is in the hands of these two payment providers. So I think it's a worthwhile experiment, and clearly the PBOC is going to set the standard on this for many other countries as well. Will the DCEP really be a game changer in international finance as well as it might be in the case of domestic finance? I don't think so. Certainly the initial design of the DCEP is that it is meant for domestic use only. But if you think about cross-border payments, these are all digital already. I mean, certainly there are some suitcases of money going across national borders for illicit reasons, but most international legitimate payments are all digital already. What I think is the potential real game changer is not the DCEP, but the cross-border interbank payment system which China has set up. That I think has the ability to talk to international payment systems and even has messaging capability that could ultimately displace SWIFT. So if you think about the CIPS as being able to link up with international payment systems, as being able to provide a messaging conduit, that could certainly reduce the dollar's importance as a vehicle currency. It could reduce the ability of the US to twist the arm of SWIFT in order to impose financial sanctions on other countries. But ultimately, going back to a point I made earlier, the real issue about whether a currency is accepted both domestically and abroad really comes to the credibility of the institutional foundation supporting that currency. So if the PBOC remains under the control of the government, if China does not have a very open capital account or a flexible exchange rate and doesn't have well-developed financial markets, just having an electronic version of the central bank money by itself will not make the renminbi a major player in international finance. But if the DCEP serves as a catalyst for some of these developments, certainly that will help. So I don't view the DCEP as a game changer on the international front, but certainly it's the start of something new and interesting.
Okay, thank you. If you want to add something, I welcome you to interject. Shinichi?
Yes, thank you. And well, I think that digital currency alone will not be enough for to be a trigger to be a reserve currency. The people should use as an invoice currency, and there's no motivation for international traders to use renminbi at this point. But so this is a kind of things in not in the near future. But also one important thing is that to be an reserve currency or the reserve currency country, in time of stress, the central bank of reserve currency country should play a role of providing liquidity as Fed did in the global financial crisis and this time. So it's not just a digital form of currency or these kind of things, but the whole system of providing liquidity to the market is a necessary condition to be a reserve currency. And that's what happens during a transition of the reserve currency of sterling pound to dollars. We have experienced the great recession. That's kind of things is one factor we should think about. And about the Chinese CBDC model, I think that I understand that it will be issued in an indirect model through intermediaries and the hybrid of account and token-based technologies. And it's also have some restrictions on the amount of holding. And these features are within the range of options we may explore. But there's one delicate issue of privacy. They say that the CBDC will be a controllable anonymity, which means that transaction data will not be disclosed to third party, but will be reported to PBOC. And as I said earlier, we should consider who obtain and manage what data under what conditions. And this is one of the most important questions to be discussed in each jurisdiction, and answer may be different among countries. But at least for us, the privacy is a fundamental value. So I don't think that the Chinese renminbi or the e-renminbi will be an international currency as it is. Thank you.
Thank you. John, do you want to add something?
Not too much on China. I agree very much with Eswar's point that I don't think that CBDC itself is the issue here. I just make one more general point, which is any transaction you do now in international currencies has to go across the books of a central bank at some point in some form or another. And if the whole correspondent banking system is set up around dollars, which it is at present, while you can maybe go directly from pounds to euro, other trades will go through the dollar on its way to going to wherever it's going. And of course, if you come up with a form of payments that don't go through banking systems and therefore don't go through central bank settlement at the end, then your payment won't have to clear across the banks, the books of the New York Fed. And then you get into the question, I think, of just the way in which sanctions, anti-money laundering, all those things, counter-terrorist financing, have been applied, particularly by the US at the level, if you touch the US financial system, and you really have to for many transactions because it's got to go through those books. So there may be something, if alternative rails develop that don't travel through bank ledgers and central bank ledgers, there may well be questions for authorities about, well, are we happy with not having those? I mean, that's the other side to the privacy coin in a way. And that could, the development of these things could affect the use of the dollar in that sense, I think. But that's not a China-specific issue. It's a more general issue.
Thank you very much. Since we are already in the overtime range, that I'd like to wrap up the discussion unless you have a burning interjection. And I apologize to the audience that I couldn't ask all the questions you asked in the Q&A box. But one question which was asked by several, if the stable coin is based on SDR, then why not IMF issue digital currency based on its SDR? But I think this is a topic of next next webinar, maybe a year from now, when the G20 report is issued. We would like to invite 3 of you again back to the webinar, pick up on what we are left today, and discuss further central bank digital currency or global digital currency. I think we had really interesting discussions, and I think audience enjoyed. I see in the Q&A box, appreciated very much of the very succinct, straightforward analysis of where we are and what the central banks actually try to do. So many experiments are coming and many discussions are coming, and we'll come back definitely to this issue. And thank you very much for joining this. And this has been the event organized by SIPA and co-sponsor outreach partner with Center on Japanese Economy and Business at the Columbia Business School. And we say thank you and goodbye.